Okay guys, we are live. I'm just opening the live here to see your comments. I see your comments, people writing down first. Nice to meet you. I'm Raffaello. So in this kind of session, I'm just waiting 2 minutes for more people to join. We have comments here, we have people joining, great. So what we'll talk in this live, what we are trying to do together with Fundedelite is to have some sort of better understanding about what really moves the market, okay? All those lives will be based on looking at fundamental data, okay? Specifically now, where we are in a situation where, as you of course know, we have a war going on, we need to look deeply at what really moves the market. What really moves the market in general are fundamentals. If you see me looking there, because as you can see, I have the screen here and the camera is there, so it's not that I'm not looking at you. If you see me looking down is when I'm reading comments, okay, that you're placing. Now, what is really important in general to always recognize is that markets always move for a fundamental reason, okay? The idea here is not to do a general, outlook, not having just a news recap and call it fundamental analysis, but actually explaining to you the real reason why market move. Okay, technicals are important, but technicals, especially in situations like this, they need to be absolutely paired with fundamentals. Okay, when we are in a situation where we have a war, like in that case, that will of course move the market, specifically the oil market, that, as I will tell you, is connected to pretty much everything. We need to look at the real fundamental reasons, okay? So I will stop to read the comment at some point because otherwise I can concentrate. I have my notes as well here because we need to talk about a lot of stuff. Later, toward the end, I will have a brief 5-10 minutes for Q&A, all right? So if you're going to ask me a question immediately during live, possibly I won't answer to you because otherwise I will lose track of what I need to talk about, okay? So we'll have a full Q&A later. So, first of all, now, if you talk about Forex, oil, gold, stocks, even crypto, okay, everything always revolves around fundamental analysis, understanding macroeconomics, understanding the fundamental outlooks of things, okay? This is what we need to focus on. What we are trying to do in this live is to actually understand what really will move the market and most importantly the reasons. Okay, when we trade, I trade since 8 years. I didn't have an introduction about me, but I trade since 8 years. I manage capital for a hedge fund. I have plenty of capital under management. I do this professionally. Okay, so I traded with pretty much anything. I then found my way in fundamental analysis. I have my own model. What I want to explain here, what I'm very interested in giving you is a general understanding about fundamentals, cause and effect, okay? Markets don't move casually, okay? Every time we see markets moving, okay, it means that there are billions of dollars moving the market, especially when we talk about Forex, gold, commodities, where you trade the most. Of course, if we look at small cap stocks, okay, very little companies, in that case, we can expect the market moving with maybe just a couple of billions, okay? When we talk about the Forex market, gold, oil, those are tens or hundreds of billions actually moving the markets, okay? Nobody is putting all of this capital because there is a pattern, because there is a whatever, guys, a fair value gap. No, the main reasons are fundamentals, all right? So what banks, hedge funds, investment funds, government are looking, even when they're doing operation, are always fundamental, macroeconomic situations, okay, macroeconomic variables, right? So what we do here, we go and understand what's moving the market and why, specifically why, you should always try to understand the reason of something, even if you have a strategy that works, okay, I have no doubt that all of you are very great at trading your prop account. In general, you would always need to think about what? Always think about why does this work. Now, very quickly, one thing that I was forgetting about telling you, for everyone that is joining this live together, at the end of the live, for who remains until the last minute, basically, there is an ongoing giveaway. Okay, so you are winning. Fundedelite is giving you 300K light one-step challenge. Okay, so 3 lucky of you will win one 100K challenge each. Okay, only if you stay until the end of the live. They will actually complete the giveaway next week, so you will find it in your email. More on that later. So just know, by participating to this live, not only you have free information, free knowledge, free value, but other than that, you also have the possibility to win a 100k account, because Fundedelite is so generous. All right, so now back to the actual fundamentals. Okay, now what I do, I will explain you the situation as of now. I will tell you how to potentially trade this. I'm not giving you signals, because you don't need signals. You need to understand how to trade yourself. Then we will look at what can possibly happen next week. Okay? Now, first thing that we need to discuss. The market goes always toward crisis. Okay? We have crises, I wouldn't say every year, but very often in the market. At the same time, markets, especially the forex market, finance in general, is relatively a new field. If you think about it, even when the closest thing I can think about, if you think about the 2008 crisis, the great financial crisis, okay, in that specific period, central banks introduced what? The non-conventional monetary policy, okay? So quantitative easing, quantitative tightening, yada, 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 okay? If you add a stochastic approach, a technical approach, before that, after the introduction of the new way, the new paradigm of monetary policy, you wouldn't be able to actually be profitable, because you wouldn't understand what happens, okay? So finance is a field that is new. It's always evolving, okay? To understand how to actually trade it and how to adapt to all of these changes, we need to understand the little moving parts. Okay, we need to understand deeply what are the little moving parts. Now, I'm reading you are asking a lot of questions. Please, guys, again, we will have a Q&A at the end of the session. I'm telling you this just because maybe I won't read your question while I'm explaining stuff. Right, so last 5 to 10 minutes we will have a Q&A and I will read all of your questions. If you write them now, probably I won't read them, okay? So, once we said that, since finance is always evolving and we need to understand the little steps, first of all, how the little moving parts, the first thing that we need to do is to look at the past, okay? We need to understand what happened in the past, because now we have a crisis, okay? And every time, I saw some crises, okay, in the market since I trade. Every time there is a crisis, everyone tells, no, this time is different, this time changes, this time is the big crash, and most of the time this is not the case. As of now, it never was the case, okay? Yes, politicians change, the market changed, the situation changed, but at the end of the day, markets are moved by people, all right? So in general, we can have a general understanding about how people behave in certain situations, okay? So the first thing that I want to explain to you, we can look at the oil crisis as of now. The biggest factor of the current geopolitical situation is the oil crisis, oil prices that are skyrocketing, okay? So one of the examples I want to show you, I recommend you after this live, go and try to study this yourself, okay? You can go and look, because we had plenty of energy crisis, okay? The one I'm explaining you now is the Gulf War, okay? We had in 1970-ish, something like this, when we had Iraq invading Kuwait, same thing basically. All right, so the example I'm giving to you today is the Gulf War, okay? I got confused. In the 70s it was not Kuwait, sorry. What I'm talking to you about today is Kuwait, okay? Iraq invades Kuwait, then we had the Desert Storm Coalition and so far. This is the Gulf War, okay? What happened in the Gulf War? In general, it is pretty, I wouldn't say identical, but it has some kinds of similarity with the current situation. If we go here and we look at what happened, basically in August 1990s, Iraq invades Kuwait, okay? So we have an energy crisis all over again. Immediately, oil spikes from $22 a barrel, good times, it was very cheap, up to 41. So we have a 74.8% movement, a 75-ish% movement up, okay? This is a lot. The highest point was reached 68 days after the conflict, okay? Then we had, in all of these periods, you know what happens, you can see it also now, headlines. Every time a big news happens, what is an headline? An headline is a news that you would see in the first page of a newspaper, okay? So something like a news specific about the war, okay? Something that you don't have on the economic calendar, Forex Factor, investing.com, FX Threat, whatever it is, okay? You don't have it there. So headlines will move the market, okay? As we can see also in this, on the left we have the Gulf War and on the right we have the current situation. We can see that oil is just not bang like this. It goes and retrace, okay? So during all this period we have some retracement. Then what happened specifically, the 16th of January 1991, the coalition, the United Nations basically, they launched this Desert Storm operation. So they started to actually get involved in the conflict. The same day that this happened, we can see how oil lost 40%. It went from 32-ish down to 19. Okay, so this is a 39.85% movement, let's say around a 40% movement in just one day. Okay, and after just a little while later, specifically this was the 28th of January 1991, we had a ceasefire. As you can see, basically we came back to prices even lower that we had when first the conflict started. Okay, so as you can see, it's cyclical. Okay, when we have a geopolitical situation that can bring instability to market, the market will react based on that. I'm reading a comment, one day 40%. Yes, 40% in one day. Just as a general understanding, 40% on Euro USD would be to move, to keep it large, from 1.10 to 1.50. Okay, something like this. This is what a 40% move is. Okay, hundreds of billions of dollars of movement. Now we are back in the 1990s, lower inflations, of course, you can understand it's a different situation, but 40% one day. You see what the market did. The market in that case didn't react to a sweep of liquidity, whatever, a fair value gap, a volume or stuff like this. It moved based on fundamentals. Okay, that was an headline. Okay, we have the Desert Storm operation starting, bam, down. Okay, this is basically the move. This is the logic. And you can see immediate move. Again, it wasn't because of a technical concept, it was because of a geopolitical situation. That geopolitics is part of what you do in fundamental analysis, what you do in the global macro approach, the same approach I'm using, okay? My approach that is called IMD, Inner Market Dynamics, it is basically a derivation of the global macro approach. The global macro approach is pretty much approaching the market in a speculative way by knowing that the biggest movement, every movement actually, is created by what we call fundamental shifts. A fundamental shift is an event that moves completely the dynamics of an asset. As an example, I will give you a very, very stupid example, but it's very easy to understand. I love analogies. Imagine you guys like milk very much, okay? You love milk, okay? Milk, okay? Standard milk. Tomorrow, in your country, the government decides, okay, milk is illegal, okay? They go crazy. They decide milk now is illegal, okay? If, as of now, you paid milk, I don't know, $2 per bottle, I have no idea how much milk costs, to be honest. But let's say $2 per bottle, okay? When it becomes illegal, it will be harder to get it, okay? So imagine you very much love milk and you decide, okay, even if it's illegal, I will get milk regardless. So maybe you find a plug, a pusher that will give you the milk. If you go to the pusher, since now it is very scarce, it's hard to find, you will be okay maybe in paying the milk $10. Okay, why? Because, of course, now it is illegal, it's harder to find, so there is a fundamental reason behind that allows you to say, okay, maybe usually I wouldn't pay $10 for a bottle of milk, but now, because of the situation, I would. Okay, this is the logic. A fundamental shift is... milk analogies on point, yeah. I love analogies. For example, when I need to explain repurchase and reverse repurchase agreements, one of the unconventional monetary policy, I talk about rockets, I talk about interstellar and stuff like this. I love analogies. But yeah, this is the analogy. You see, why are you okay in paying $10 per bottle for the milk? If you go now to the supermarket and if you see the milk is $10 a bottle, you say, go fuck yourself, I'm not absolutely buying it. But in that specific situation, in that random imaginary situation where now it became illegal, you would be okay. That is the same thing. When a fundamental shift is a fundamental reason, a situation that changes the dynamics of what people, investors, traders, bank, hedge funds define as cheap or expensive, okay? This is exactly what happens. This is a fundamental shift. And this is also, for example, why oil dropped 40% in one day because, of course, the market started to price in, all right, with this move, with the Operation Desert Storm, now the war will be over and all the crises behind oil will be solved. One important thing, guys, that you need to remember is that, and we can see it here, oil dropped the exact same day where the operation started, okay? When raids started, when bombing started, okay? From the coalition. The war wasn't over yet. The war then, we had a ceasefire about 12 days later. Okay, so it wasn't finished yet. But the market is forward-looking. The market always thinks about the future. Let me write it down here. This is important. I have a lot of tattoos on my arm. I don't have this, but I will do this. Tattoo this on your arm. Markets are forward-looking. You won't see it now. Let's put it in white. Here it is. Markets are forward-looking. This is one of the most important things that you need to understand to actually live off trading. Markets are forward-looking. They look into the future. They will price in the future. Okay? They won't price in the current situation. They will price in what they expect about the future. Okay? Of course, we have assets that are more reactive and assets that are less reactive, but in general, the market will always think about the future. Let me give you another analogy here. How do you explain this? Because it is in the market intrinsic nature to look about the future. Imagine if you today go and you invest into a stock, into a crypto, into gold. Okay, if you buy a crypto now, for example, because you want to make money, a meme coin, whatever it is, okay, you invest in something, let's say a crypto, and you want to make money off of it. You will buy the crypto only and only if you think that the crypto will go up in price. Otherwise, it wouldn't make sense. That would be stupid. Why would I buy a crypto that I think it will go down? So you see, it's my intrinsic nature. If I want to be a speculator, if I want to make profit of the market, necessarily I will need to have an expectation about the future. So it is in our intrinsic nature. So every market participant will have expectations about the future because we are in the market to make money. This is our job. Okay. So if you are thinking about making money on the long run, 100% intrinsically, by your own nature, you will need to have some sort of expectation about the future. This is reflected in charts every single day. So every time you see the price of an asset, can be Euro USD, can be gold, can be Nasdaq, can be whatever, okay? The current price that we see now is the sum of all the future expectation that all market participants incorporate in the price, okay? So this is extremely important. The markets are forward-looking. The market is not an entity. When I talk the market, I mean all, traders, hedge funds, investment banks, etc. It's not an entity that reacts on. People don't talk about cryptos nowadays. I hate cryptos, for example. I'm not into cryptos at all. It was just to do the example. I could have done the same example on gold. But in general, when we see any movement in the chart, is because market participants are forward-looking. Okay, the only market participant that is not forward-looking and it is data reactionary, those are the central banks. Okay, central banks, the Federal Reserve, the ECB, the Reserve Bank of Australia, the Switzerland National Bank, all of the central banks, they are data reactionary. They are reactionary. They react off markets because their objective is not making money on the market. Their objective is to be supervisor, to make sure that everything falls in place, that everything stays stable. They usually have two mandates, they actually have three. The first mandate, they need to keep inflation stable, they need to keep maximum employment possible, and the third one that people usually don't tell you about is that they need to keep the banking system stable. They need to keep the banking system stable. So by their nature, they won't think about, okay, I'm going to inject liquidity now so I can make money in the future. No, they can only react on data. Okay, so they are data reactionary. Those are only the central banks though. Okay, all market participants are forward-looking. So every price that we see is based on expectation. Now, this was a big digression. Okay, was to explain why the market dropped 40% in one day just when the rate started. Okay, now, if we want to look at gold in that case, if we just overlay the price of gold, we can see that of course, the blue line is oil and the green and the orange line is gold. We can see that the movements were pretty much identical. Okay, they were very, very similar. Okay, because the market moved and invested into gold exactly because they were pricing in risk. Okay, gold is a risk-off asset. Gold is an asset that notoriously the market will go and invest into when there are fears and doubts about the stability of the financial system. So gold had very much power in that specific case. Now, let's go over the current situation, okay? What happened now? Now, specifically, if we go on the right chart here, we have the current situation, okay? We can see Friday, 27th of February, that was the last day, the war started exactly the 28th of February, and it was Saturday, of course, then markets were closed. So the first day after, on Monday, 2nd of March, we saw immediately a big spike in oil. If we see the price movement from the first trading day after the war started to now, we are up 66.54%, okay? 66.54%. Again, it's a lot, guys. It's a lot. It's a lot. It's a lot. Those are 4,400 pips, okay? So not 10 pips, 15 pips, no, 4,000 pips, okay? We are talking about big numbers in that case. Then on oil, some people say that this is 4,000, some say that this is 400. 4,477 points, if we want to talk about this. Okay, we moved that much. We moved $44 on the price of a single oil barrel, right? Why? The market reacted immediately because as soon as the strikes on Iran from US and Israeli forces started, Iran in retaliation, they closed the Strait of Hormuz. Now, what is this Strait of Hormuz? Everyone is talking about it, and I see very few people will know how this works. The Strait of Hormuz, simply, it's a passage where big cargo ships go and then bring oil to different parts of the world. We have about 20% of the global oil supply that goes through the Strait of Hormuz. Okay, 20% might not sound that big, okay, but it's a lot, okay? 20% of the global oil supply, it's a lot, okay? So what happened specifically is we saw the price spiking, okay? Iran did this in retaliation because they know that by blocking oil supply, this will generate a lot of problems because oil brings inflation. But the type of inflation that energy brings is different from the normal inflation that, for example, we had after COVID, okay? And I will explain this difference in a minute. It's very important. It's extremely important to understand because it is a very big distinction, okay? So simply the market skyrocketed, of course, on oil prices. Then what happened? We can see some sort of retracement because we had some kind of the market tried to solve the situation. We have, for example, in that case, fiscal policies. A lot of governments are giving fiscal stimulus to allow the market to actually, the people, the citizens to live. For example, in Italy, I am originally from Italy, so I know this. Now there is a 24%, something like this, reduction on oil price, on diesel, petrol, etc. This basically is the government removing some taxes, okay, on fuel. Those are fiscal policies. Fiscal policy is something that the government can do to help citizens. So we tried this. The IEA released it was about 400 million barrels of oil, something like this. I have it in my notes about here. Yeah, 400 million barrels from reserve, from tactical reserves. And this created a bit of, retracement, but yet now we are again at all-time highs. Because the market is expecting the war to not simply end. Okay, now, attention, when we look at the previous chart, let's remove this for now. When we look at the previous chart, let's remove gold as well. We can see that we went back to the same level before the actual war broke out in the 1990s. After, in that case, it was 169 days. Okay, almost 6 months. Okay, so it was a bit of time. Now we are at 34 days since the beginning of the conflict. We all hope it will end soon, but we don't know. Okay, so there were a lot of tries, the market tried, government tries to ease the situation off, but of course, as someone I see is commenting, the whole world is getting impacted. That's the thing. That's the strategy that Iran is trying to use. Of course, they are going to create problems worldwide to put pressure on US, Israel, all allied countries to end the war as fast as possible. They know that they can create damages. Okay, this is also why they're attacking all Gulf countries, UAE, Dubai. I was in Dubai just 1 week before the war broke out, so I was very quick in flying out fast. But this is what they're trying to do. Now, the main logic is, I'm reading, reply to my question, please. I told you guys the questions later. Is there an alternative to the Strait of Hormuz? There are alternatives, but still, if you go look geographically at that specific point, it is a pretty close point. We can look at it very quickly. If we go on Google Maps, Strait of Hormuz, let's see if the map opens so we can see together. This is the Strait of Hormuz, okay? You see? It's close by the Persian Gulf, okay? So if oil needs to come outside this place, if it needs to come from here, it needs to pass through the Strait of Hormuz, okay? So alternatives, from the Strait of Hormuz, it passes only 20% of the global oil supply, okay? Not all the oil supply, but still this creates a very big impact, okay? A very, very big impact. Again, fundamental shift is if a commodity, in this example, oil, is scarce, okay? Of course, the price will move a lot. I'm reading carries just 20%. Yes, but 20% is a lot. 20% is actually a lot, guys. It's a lot, 20%. It's not little. 20% looks little, but trust me, 20% of the world oil supply is a shit ton of oil, okay? So this is why it moves that much. Then, of course, the market will also price in additional retaliations, etc. But again, I just responded to this question very quickly because I see that you posted it multiple times. Please Q&A at the end. Otherwise, I will lose track of things. It's not easy. It's not complex, but it's neither easy, all the things that I want to explain. So let's not lose track of it. So in general, now, of course, I lost track. We were talking about the current situation. The IEA released some barrels, but still the situation is different. Now, one thing that we can see differently is how gold reacted. As of now, the usual type of movement is oil spikes, okay? Usually gold follows because of the fear and the risk involved. Then when the situation goes back to normal, we have then a move back to the original side, to the original point, and the market continues normally. Now, in my model, what I like to call this, the FGR hierarchy. The market, in my opinion, in the way I read the market, because again, I think one of the biggest turning point of my career was starting to find my own explanation, okay? For me, the market moves because of three main reasons: fundamental, geopolitical, and risk sentiment. Okay, fundamentals, of course, all economic data, geopolitical element like this, risk sentiment can be in general also COVID, for example. It can be COVID, it can be the big 2008 crisis, and so on. Okay, usually geopolitical and risk sentiment get overlapped. Okay, they get overlapped usually because think about this. Now we have a war that is a geopolitical event, but of course carries a lot of risk because there is the possibility of this expanding that could bring potentially, we hope not, God forbid, a world war. Okay, so of course we have both the geopolitical side and the risk sentiment. Usually the FGR, what I call the FGR index, I have a specific indicator that explains that. I can show you, this is my FGR, and this is my private terminal. I have my own trading terminal. The FGR index basically takes a bit to load because it is a lot. It is a lot of that. This FGR index basically tells me when the market is acting rational or irrational, okay? If we go and we look at the first trading day after the war broke out, we can see that FGR, the 2nd of March, spiked to 55. It's a very high level. This was signaling me that the market was reacting in a very rational way. We had a lot of movement, we had a lot of volatility. It's not only the VIX. I use the VIX, for example, to calculate this as well, but it has just a multiplier effect. To calculate this, there are more than 140 data points, so a lot of stuff. But in general, with this, I can understand, right, the market is acting irrational. When this happens, fundamentals can lag, okay? They can be lagging. What does this mean? The market ultimately will always move, and I say, trust me, always move because of fundamentals. But when there is another situation like a geopolitical event, a risk sentiment event, and so on, fundamentals can lag, okay? Imagine it's like the price needs to move, okay, but it has a ceiling. on it. One example that I give to people, another very stupid but easy to understand analogy, imagine New Zealand, okay? Let's say the New Zealand, okay? New Zealand has very good inflation, very good employment, the GDP is increasing, the production is increasing, the PMI is increasing, so I could think, right, New Zealand will expand as an economy, so I can potentially invest into the New Zealand dollar, okay? Now imagine there is some state that says, okay, tomorrow I'm going to nuke New Zealand. Again, it's just an example, God forbid. Tomorrow I'm going to nuke New Zealand. Of course, nobody will want to invest in New Zealand if you have this kind of risk involved, all right? So specifically in that case, even if the fundamentals of New Zealand are extremely positive, the market won't go long on it because it is focusing on a geopolitical or risk sentiment based event, okay? This is the exact reason. So you can see, in that case, even if the fundamentals tell you go long on New Zealand, the market will not reflect this expectation. This doesn't mean that fundamentals don't work. Wait, this means that fundamentals are lagging. If the day after, the government that threatened New Zealand says, no, I was joking, the New Zealand will spike up. Because again, it's like there is a ceiling that is stopping the price to actually respect fundamentals. As soon as this ceiling is removed, bam, we had the movement, okay? Fundamentals get in place again, all right? This is my average outlook of things. What can happen usually is that if the geopolitical or risk sentiment event lasts more than, let's say, 1, 2, 3 months, and the fundamentals in the meantime change, then the market won't respect the fundamentals. This doesn't mean that the fundamentals don't work. It means that fundamentals changed while we had this ceiling. So imagine, New Zealand, extremely good economy. Then there is a risk that will tell, like the example before, a potential nuke, okay? Again, we're joking, it's just an example. Potential, something very bad that can happen to the country, I say, okay, I'm not investing in it, so I have the ceiling. If this risk remains for 2, 3, 4 months, maybe the fundamentals will change. Maybe the employment will go lower, the GDP will go lower, the PMI will go lower, so markets say, okay, right, now it doesn't make sense anymore to invest in New Zealand. So even then, if after 2, 3 months the government says, no, we were joking, we don't want to declare war on New Zealand, the New Zealand dollar will not go up because fundamentals change. So as you can see, geopolitical and risk sentiment-based events can make fundamentals lack. Then the market will always revert back to fundamentals. Now, in that specific case, when we look about oil, if we correlate it again with gold, we didn't have the same thing, okay? We didn't have the same situation. As you can remember, in the past, gold basically was extremely correlated with oil, okay? Basically followed almost the same, all right? In that case, we don't see that. In that case, we see that actually oil is going up and gold is going down. Now, why is that? I would love to ask you the question, but unfortunately we have 1 to 2 minutes of lag during live, so I can't. Otherwise, I would love to discuss it with you. I will give you the answer immediately. It is very interesting to think. In that specific situation, gold didn't immediately follow oil. As you can see, in the last 2-3 weeks, gold went up. Okay, we moved from 4,400-ish to 4,700, something like this. So it followed a bit, but not that much as in the past. Why is that? This specific situation here, it's because one, in recent months, we had gold that reached all-time highs. Okay, so the market already started to liquidate some positions. Then we have another thing that we need to remember. All right, from 2026 to the 1990s, the finance landscape changed a lot. One of the things that big hedge funds do, don't think that if you think about the biggest hedge fund, the biggest investment bank, Goldman Sachs, JP Morgan and stuff like Credit Agricole and stuff like this, don't think that they simply trade exactly like us. They will go and trade on Euro USD, on GBP USD, on gold, etc. They of course do that as well, but they invest in a lot of exotic assets. Okay, so for example, we saw a big movement last year on the South Korean stock market. It's called the KOSPI. Okay, it's that one. Okay. We can see that last year we had a very big move. Okay, if we look at 2026, from the beginning of 2026, that it's year to the absolute high with a 46% movement. Okay, it's a lot for an index. This is what we could compare the S&P 500 for America. This is for South Korea. We had a lot of movement. Now, here we start to talk about currencies in that case. What happens? In general, in that specific situation, hedge funds that invest in exotic assets like this, we can see that the South Korean index started to fall a lot, okay? As you can see, this was again the 27th, 28th of February. Again, the 28th of February when the war started was a Saturday, so of course the market were closed, but immediately the next day we can see that we moved from this relative high. In the next day we lost 7.5%, and the next day as well the absolute loss was 18.5-ish%. Okay, so it lost almost 20%. An index that loses that much, it's a lot. Okay, it's like seeing the S&P losing 15-20%. It's a lot. Remember, the S&P lost 20% last April. If we go on the S&P and we go look on the daily time frame, let's put a line chart and we see what happened in April 2025, we can see that we moved from the relative high, from here, we lost, yes, 18.9%, about 20% as well. This was because of the trade war of Trump. Having this kind of movement, now don't think about, oil, 40% in one day, right? Index, okay, an index, it's extremely liquid, it's extremely big, all right? So this is a lot of movement. Why this happened? Because currencies, more than currencies, economies, they have a very good sensitivity to oil and energy prices. Specifically, if you look at South Korea, Japan, okay, on the Asian side of the world, those nations are very energy dependent, okay? The biggest one that we can think about is Japan when we talk about the G8, so the currencies that you usually trade on the MetaTrader, okay? USD, Euro, JPP, JPY, AUD, NSD, CAD, and CHF, okay? JPY in that case is Japan is the most energy angry, okay? So specifically in that case, we can see also, for example, South Korea is a very big producer. I think it is the second biggest microchip producer in the world. If I'm not wrong, it's the second biggest, okay? So to produce all of this, you will need a lot of energy, okay? When you think about oil, it's used in the economy as a whole. If you think about, of course, the first thing that you see, okay, I'm paying a tank at the gas station from 80 euros to 140, okay, the first thing that you see. But then agricultural companies, okay, you need machinery to go and crop and stuff like this, so additional cost. Transportation, if you live in the US and you want to buy a good Italian wine, some product from overseas, okay, that product needs to be moved from Europe, as an example, to the US. To move this, you will do it either by plane or more commonly by boat, okay, by big cargo ships. They consume oil, okay, diesel specifically. So the price of everything goes up. The price of everything goes up. So in that specific case, since I was telling you that funds and hedge funds, investment banks, etc., will go and invest a lot into exotic assets like indexes of Korea, etc. When all this crisis started to take place, also the S&P lost a lot. We can see a lot of indices, they lost a lot of equities, a lot of stock indices lost a lot. The S&P from the absolute all-time high, it lost the minimum almost 10%, okay? So what happens in that case is that some of the funds, every investment fund has something that is called a VAR, value at risk. They have specific model of risk management that allow them to risk more or less, okay? They can just go and full port an account like maybe we can on the MetaTrader, okay? They have rules. So when we see these big spikes down, some of them will get margin called, okay? We'll have some margin call. So it means that they need to replenish their account because they're losing margin to respect their value at risk, right? Where can they get the first big amount of money to replenish this situation? From trades, from assets that were in profit. So if we saw that during all of 2020, but towards the end of 2025, gold had a very big rush from September to January 2026 with a 64% move. The first places where I will grab profits to cover my margin when I'm losing, for example, on exotic currencies, exotic stock markets, will be where? Will be exactly where I have, as of now, the most profit active, right? If I bought gold, I'm an hedge fund and I bought a lot of gold and I'm running a profits, if I want to liquidate this profit, to realize this profit, what I need to do, I need to sell it. And this is why the chart goes and reverse. So you see, with fundamental analysis, you need always to look at a lot of stuff. Okay, you need to look at a lot of variables, because in general, finance, it's not very hard. Okay, it's not rocket science. Okay, to understand the main concept of finance, it's not difficult. The difficult thing about finance is that it's extremely complex. There is a lot of stuff, a lot of variables. The thing that you need to learn how to do is to connect all the dots. All right? So this was the first part. What we need to expect now. Talking about inflation. The risk with an oil crisis is exactly the inflation side. Okay? The inflation side of things, because as I explained before, if you think about agricultural companies, you think about transportation, you can think about everything, the costs will increase. Okay, a stupid example, guys, if you buy things off Amazon and you have Amazon Prime, the delivery of the package will use fuel. If the fuel price skyrockets, at some point Amazon maybe will tell you, yo guys, we need to increase the Prime membership. Same thing if you think about AI. Now everyone is talking about AI. AI use a lot of electricity to compute, right? Now, of course, you don't use diesel generators in OpenAI or Anthropic to power up the servers, but in general, what is following oil prices are gas prices. If we go and we look at the current gas prices, gas, I don't remember how it's the ticker of gas prices. Let's see. What is the ticker of gas, guys? I don't remember. No, not gas, yeah. If we go also on natural gas, I can find it now, not natural gas, it's the megawatt. Right, guys, I don't find it, but in general, also electricity costs are increasing for this exact crisis, okay? This is an energy crisis, okay? Oil brings a lot of consequences with it. Excuse me, I didn't look at gas, I don't remember the ticker, I don't trade gas to be honest, I never traded gas in general, but also electricity costs are running. So also subscription like OpenAI, Anthropic and stuff like this, AI will go and will increase in price, okay? All the energy field is increasing. If we look, for example, also one of the things I do, I invest in uranium, okay? This specific ETF tracks the stocks of the smallest, the junior uranium miners in the US. We can see that we had a very big expansion at the beginning of the year. Let me see if I can increase this chart for you. I didn't increase the correct one. Thanks, TradingView. Okay. We had a very big expansion from the beginning of the year. We can see from here, the absolute high was at 50%. Now it's contracting, okay? Because the whole energy sector is getting hammered from this situation, right? Now, how do we correlate with this with everything else? How do we correlate this with gold and Forex? Gold, theoretically, should go up in a specific situation. Gold, usually, as I said before, goes up when there is fear about the stability of the financial system, okay? One of the reasons why gold went up during the end of 2025 was because we had a lot of tension on the US side with tariffs, okay? We had a lot of tension between the US government, between Trump and Powell, okay, the chairman of the Federal Reserve. If you remember, Trump was basically saying one day and the day after as well, he was saying, no, Powell is stupid, he shouldn't be on the Federal Reserve, I want to fire him. This is not a very good message for the market, because the market will think, right, there is instability on the rise. And so they started to lose a bit of faith toward the authority of the Federal Reserve, of the US dollar, and they preferred to invest in something else. Okay, this is also why gold went up a lot. So gold usually gets power when we start to lose faith in the current financial system. Now, the difference between supply-derived inflation and demand-supplied inflation. What usually happens is that when you have normal inflation, okay, this can happen, for example, let's say, this can happen, for example, after COVID, okay? During COVID, especially the US, we had a whole lot of movement on the, a whole lot of injection of liquidity. If we go, for example, and we look at the money supply of the US, specifically M1, we can see that during COVID, let's go here, let's look at the money supply. M1, United States money supply M1, we look on the bar chart. We see all the data, we can see that the money supply Specifically, when we look during COVID, we passed in just 1 month from April 2020 to 4.8 trillion, okay, 4.5-ish trillion to 16 trillion USD, right? This was an extremely big inflation, okay? Inflation in that case is demand driven. We had inflation. Why? What is inflation? Loss of purchasing power. In that case, the US dollar and then all the other G8 currency, but that usually mainly because it was imported kind of inflation. We had a specific movement on the money supply that created a lot of inflation, because if we have more currency around, boys, ladies and gentlemen, if there are ladies watching, in general, what we can understand is that 90% of the dollars that as of now are around the world were created 4 or 5 years ago, were created during 2020, okay? This is a shitcoin, basically, okay? We were talking about cryptos before. This is a shitcoin. The US dollar has become a shitcoin, okay? So we had a lot of injection of liquidity. Of course, in that specific way, with a lot of oil, dollar supply, okay, we had a lot of supply. Inflation increases because the actual value goes down because we have a lot of it. It's not scarce, okay? This is normal inflation where we have injection, okay? Inflation can be created as well when we are in a growing phase of the economy by overeating the market, okay? If the market overeats, usually inflation goes up, because think about it, one of the main things about finance is the Phillips curve. The Phillips curve explains to you that we can't have a controlled inflation in an economy, in an economic system, if all of the people are employed. It's one of the bad things about finance, that if you study, you can understand that unfortunately to have a stable economic system, the economy requires to have a little amount of people unemployed, okay? So when we are in a very big growth phase, a lot of people are employed, a lot of people are making money, the profits of company are increasing. If the profits of company increase, they go and hire more people. If more people are hired, more people will buy houses, more people will buy cars, etc. So we have a lot of increase in the demand. This pushes, of course, the price up. If the offer stays the same, and if price goes up, demand and supply, standard theory of demand and supply, the price will go up. This is demand side inflation. How we can solve this? This is usually solved by increasing interest rate, okay? If you increase the interest rate, you are increasing the cost of money. What is the cost of money? The interest rate that the central bank goes and decide, those are reference point of interest rate. The central bank, what it does, it's not that when you see the Federal Reserve increase the interest rate by 0.25%, it means that they push a button and interest rate change immediately. No, it means that the Federal Reserve is starting a series of operations with the objective of realizing that target rate. That is a target rate. If you go and you look specifically at the statement of the Federal Reserve, you can look at them simply by going here on this specific page of the federalreserve.gov/monetary policy. You can go here, you click on PDF, and you can actually read the statement that the Federal Reserve released, okay? It's free, it's public, you can look at it, okay? Here you can see that they will go and tell, in support of its goal, the committee decided to maintain the target range for the federal funds rate between 3.5 and 3.75. The target range. Target. It's not that they push a button and the interest rate change immediately. It means that they're starting a series of operations to increase interest rate. These will also result in interest rate paid that you need to pay to a bank to get a loan to be higher, okay? Now, when you think about this, don't think about the loans that usually as citizens can get, because what is the biggest loan a citizen can ask? A mortgage for a house. If you want to finance a Ferrari, you will spend 200-300K, but this is pretty much it. You need to think about companies, because companies, medium and big companies, are not like small companies that go and reinvest the profit. Medium and large companies, they have unique special credit lines where they can ask 100, 150, 200 million from a bank, okay? So we have big movements here. If the cost of money changes for a company, it becomes way harder to expand operation, hire new people. These will bring what? The economic activity lower, so less people will be employed, less people will buy stuff, and this will lower inflation, because in that case, if before inflation was increased by a demand going up a lot, in that case the demand is going down. Okay, because we have less access to money, we have less access to credit. The capitalistic system revolves around credit. And this is standard inflation, okay? Now, inflation that we are seeing now with the current shock in the energy sector is a supply side inflation. In that case, inflation is skyrocketing, the price of oil is skyrocketing, because I was saying before, 20%, someone said it's only 20%. 20% it's a lot. It means that now we have 20% less oil that we can buy. So if the offer gets lower and still all the governments they want to buy oil, of the companies they want to buy oil, of course, because they necessarily need to have oil to fuel their operations, etc., they will be okay in paying a higher price because now it's scarce. It's a very scarce commodity. There is not a lot around. So in that case, it is supply side inflation. Now remember what I said before. When the central bank goes and increases interest rate, it's a way to reduce the demand. It's a way to chill out, to chill down the economy, so to decrease the demand, and this will bring prices down, so inflation down. In that specific sense though, even if the Federal Reserve, as an example, now increases rates, the Strait of Hormuz won't be opened again, okay? Interest rate in that case, if inflation is based on the energy sector for a geopolitical shock, so not on demand side but a supply side inflation, even if the central bank increases interest rates, they can't possibly modify this condition. So the worst thing that can happen actually now is having an increase in interest rate, okay, that will not only create harder financial conditions for citizens and companies, okay, but will also bring in that case to a crisis, to a potential big recession, because specifically already oil prices are skyrocketing. Now me as a company, I'm not even able to access debt, or if I can access debt, loans, etc., I need to pay very big interest rate. This is extremely bad for me. Okay, I will pay more in interest and I will pay more on oil. The economy will completely collapse, okay? Not collapse, but we'll go in a recession, okay? So what the central bank can do, potentially now, the most logical thing, that this is what happened also in the past. Again, after this session, go and look at the past. What can happen is that the central bank will do the opposite. The central bank will bow and they will lower the interest rate. Why? Because like this, they can stimulate the economy. What the central bank usually ideally would like to do, if the shock is external, if inflation is on the supply side because of an external shock like a war, if it doesn't go through the roof, the main idea is to let it pass. So if potentially now the war lasts another week, good, we are able, inflation will go down, the central bank doesn't need to do anything. But if it continues to increase, this is a big problem because they have what we call paralysis in that case. They should increase interest rate to lower inflation. If they don't do that, the market starts to think, right, they are not loyal to their mandate to keep inflation down, so the central bank will lose authority. But if they increase the interest rate, they will push the economy even in more danger. Okay, so what they do, they are paralyzed. In the past, what they used to do, they would lower rates, and gold used to go up in that specific situations. Okay, so if central banks they start to decrease interest rate, gold will probably go up. This is the main idea. How can we actually decide what we can do? How we can decide it? We can look at multiple data points. The biggest thing that we need to look for is, first of all, headlines. Okay, so we need to be updated. A rule of thumb for you, if you're a trader, you need to be updated on whatever happens in the world. Okay, as a rule of thumb, if at the end of your day while having dinner you look at the news, okay, on the TV, if they say something that you didn't know already, you are doing something wrong. Your biggest thing is to being updated on what happens. Okay, so usually we have let's say 2 or 3 situations in general. We can have, first of all, if, let's say 3 scenarios, okay? If we have a de-escalation, okay, so if the war resolves somewhat, we will have a lot of push, of downward pressure on oil, so oil will drop sharply. All risk-on assets, so indices, high beta currencies, etc., will raise, okay? JPY, that is a currency that is suffering a lot, the current crisis, will also increase, etc. Scenario B, if we have a prolonged stalemate, basically they are stopped as of now, they are not able to get to a ceasefire, get to a coalition, get to a decision, the market will continue to act irrational. It will continue to move based on what? Because on headlines and stuff like this. Scenario C, if we have an escalation, oil will probably break past $120, so it will continue to go up, and this will probably push central banks to be in a paralysis. They don't know, should I increase the rates or not? What you can do to help this, okay? What you can do, you can look at the COT report, okay? The COT report, you can see it. For example, I have it here, all the information about what hedge funds are doing, okay? You can see it as well by simply going on the CFTC website. If you go to cftc.gov, it's a public website, and you click on market data and economic analysis, okay? And you look on commitment of traders here, you will get to this page. You simply go down, you click here, financial long format. Those are all the position on, we can see Canadian dollars, Swiss franc, British pound, down we will see also commodities, etc. Okay, or the biggest American hedge funds. Okay, so all the trades that they are opening, you can see specifically what they are doing. Now, it's not immediate to know how to read the COT report, but in general, what you should do, you can always look at what hedge funds are doing. Not because even if you see, like, look, I have this one of my terminal sheets where I can know specifically, okay, for example, I know that on the JPY there are $4.3 billion short on the JPY. This doesn't mean, okay, with 4.3 billion short, the JPY will fall. No, in that case, I can just understand that since most of hedge funds are short, okay, since most of hedge funds are short, I can understand that they did their researches. They did their part of fundamental analysis, so I'm offsetting the research part on them, pretty much. Okay, now the COT there is a lot of stuff on the COT. If you want to learn more about it, you can go on my YouTube channel after this, and I have a full video explaining it. This video here explains specifically the COT, okay, so you can watch it. Now, that was pretty much it for this session. Again, for the giveaway, I saw someone texting this in the comment, okay? It will be automatic. Next week, Fundedelite, if you want, will send you an email with your details, okay? We are not doing this live together. Fundedelite will already gotten all of your details, and 3 of you will receive an email with the actual account if you want. Now, we have the last 5-10 minutes of Q&A, so you can ask now all the questions you want. At the beginning, we will have 1 minute delay because there is a delay from when I'm speaking to when you see the footage on YouTube, so I will shut up for a minute, but I'm reading your question and I will start to answer. Would you say geopolitics creates short-term volatility while interest rates define the long-term trend? This is a smart point. It's not entirely like this. It's not entirely true. It's not that always geopolitically will create short-term volatility. Geopolitics can also create long-term volatility. But the overall trend of the market is decided by, I wouldn't say interest rate, but monetary policy in general. The central banks. Central banks are the biggest market participant, and they are the one that are governing economic cycles. Okay, so specifically, usually geopolitical events, they are short-term and they create volatility, so they can make what I said before, they can make fundamentals lag. Okay, they can make fundamentals lag. If they don't make fundamentals lag, okay, they will just create a burst of volatility that after the situation will end, it will just go lower and the market will go and respect the fundamentals again. But yes, they can create big situation. The thing about finance is that everything is connected, okay? So oil, as you can see, is connected with agriculture, with, in that case, interest rate that will modify how many people are employed. If more people are employed, we have more inflation, yada, 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 okay? It's all about the connection. COT report is very important, then it can give an overall bias for the week. Yes, 100% guys, the COT report is extremely important. It was one of my first way to get into fundamental analysis, because at least we are seeing what hedge funds are doing and what I explained in the video. I have multiple videos on my channel explaining fundamentals. It's all free, so if you want and go check it out, you can. Here specifically, we create a bias. If I see, for example, that AUD-NSD, it's the biggest gainer from the COT, from the LF strand index. Again, I explain everything in the videos. It's not that easy, okay? You need to understand why we do this. We can find a potential entry on this particular pair. I use it as a bias, okay? I create my bias and then I trade accordingly. Let's see the other questions. How they will do that, I don't know what you're referring to. Are rate cuts expectation being priced in here because of the geopolitical risk? So the market, yes, it is pricing in lower rates at the moment. Specifically, if we look at the Fed funds rate, it changes like every day. If you look at the yield curves, one of the things about fundamentals that we don't have time to explain now, it changes every day. By looking at the yield curve, we can understand what the market expects about future interest rate. But as of now, the market is in a bit of a stalemate. They don't know if the central bank will just be paralyzed or they will increase rates to, save the face, show that they still care about having the authority to maintain inflation to the objective, to their target of 2% annualized, usually for most of the G8 countries. It's 2% for all G8 countries except AUD, Australia and New Zealand, that is between 1 and 3, they're a bit more flexible, and Switzerland, that it's between 0 and 1 because they want to keep inflation lower to retain their safe haven aspect. So they're in a bit of a stalemate. We need to see specifically what the price does. I clearly need to learn more about fundamentals. What are some good resources to help understand them? My YouTube channel. There are plenty of free YouTube videos about the fundamentals, etc. Go look at the videos. I think, I did the channel just to explain specifically better what fundamentals are about. So you can find a lot of resources there. In some videos, I also recommend books to read. So go check that out. These get saved? I have no idea, to be honest. I think yes. How can beginners best use this macro information in daily trading? Your objective shouldn't be to immediately use this information. It should be to have a starting point where you can start to go and learn more about it. Okay, fundamentals is not like a strategy. It's not like an indicator that you can just add on top of your analysis. Okay, you need to understand fundamental analysis specifically. So start to study it. Okay, you can start to study it from university textbooks. I have something here because I have a degree in economics and finance, but it's not necessary, right? All the things I learned in university were redundant compared to what I already knew about fundamentals because I studied it myself. Then I was lucky enough to study from a guy that used to trade in JP Morgan. I had this luck. So go and look specifically in general textbooks, or again, go on my YouTube channel. It has my name. I already showed it here before, just like this. You will find a whole lot of videos about strategy, about fundamentals. You will find everything here. It's my name and surname, Raffaello Ciotto. Everything is free. Okay, let's continue. Let's see another couple of questions, then we close. Are you checking the correlation between interest rate? Absolutely. Yes. Are you checking the correlation between interest rate and bond yields? Absolutely. I do this, and I also look specifically at the interest rate differentials between countries. One of the things that I look, for example, on my trading terminal, it's this. If we go here on the results tab, I can see the interest rate differential of every major pair. This moves the market because of carry trades, and in that specific sense can also give you an understanding what state is pricing in more cuts or more hikes. Okay, so yes, interest rates are absolutely important to look at as well. Next question, what is last 3 months selling looks too huge, so what we can expect? I don't know what you're referring to. Explain the question better. Checking from Israel, the volatility is insane, but the macro levels are keeping me grounded. Appreciate the insight. My pleasure. From the three scenarios you gave, which one is the more likely to happen? Good question. The million dollar question. If I knew that, I would have already opened the trade regardless. We don't know yet. I would say I would be more inclined on a de-escalation. Okay, also because it's the thing I hope. I would love to see people stop fucking go at war with each other. The thing is Trump. Okay, Trump is unpredictable. So we don't know. For example, I trade with fundamentals, right? But I don't trade specifically on news, okay? I'm not the type of guy to say, okay, I trade fundamentals, so I wait for the CPI or the non-farm payroll and I just go full margin on the news. No, this is not fundamentals. What you do, in Italian we say stare alla finestra, in finance, in English gets translated in the finance realm to be at the window. So what I look mostly in this situation, I check what's happening in general, and then I create long-term trades. Guys, fundamentals will not move the market always immediately like the example that we saw 40% in one day, okay? Fundamentals take months to actually take place. 1, 2, 3, 4, 6, 12 months, okay? So even after the crisis ends, we can have a shit ton of fundamental trades after this. Me specifically, I open maximum between 1 and 3 trades a week, not more than that. I do intra-week trading, my minimal take profit is 100 pips. I'm not looking to, trade every day. So I prefer to stay at the window. For example, the recent trades that I did was 2 longs on JPP CAD. In that specific case, I went long here for 150 pips and long here again for 150 pips. But those are all intra-week, okay? Those are all, as you can see behind, you can see the weekly candle. Those are all intra-week trades, okay? So don't think that trading fundamentals means trading news. No, trading fundamentals is creating a bias before actually going on a chart. For me specifically, 80% of the job is done outside of the chart. And 20% is actually execution. The chart patterns, position, stop loss, take profit, they should be the simplest part of trading. Retail sees news, institutions see repricing. 100%, man. 100%. Please show the YouTube channel name again. I leave it here 1 minute. It's my name and surname. This one. Take a screenshot if you want to. My old question are ignored, bro. I have a lot of questions. I'm not ignoring you. Are hedge funds trading gold? Of course. They trade every asset. Would you say interest rate expectation anchor the long-term move while geopolitics drive short-term volatility? We can say that. We can say that. We can potentially say that, yes. In general, when we look at interest rate expectation, we can look at the yield curve, okay? One thing that you can go and look deeper is the yield curve, specifically the difference between the yield of the 10-year treasuries of the US and the 2-year treasury is also always on the US. If you go on TradingView, you can see the yield curve very quickly. Just open a chart and type US 10Y minus US 02Y, click OK, go on a monthly time frame. If you want to see it better, this is the yield curve, okay? This is the difference between 10-year yields and 2-year yields. How long is this live for, bro? It's ending in about 2 minutes. It was 1 hour. Can you tell us, you use strategy like SMC or ICT or other? I studied everything, man. I studied SMC, ICT, volumes, technicals, GAN, moon phases, cyclical, everything. As of now, I use my own strategy. I am the inner market dynamics based on fundamentals, and I use my own trading terminal that I built after years. I basically do all my trades with this terminal where I see all the data, okay? If I want to see the data on the Canadian dollar, for example, I just click here and I have all the most important data, PMIs, NMI, inflation, consumer confidence, GDP. So I tried all of that. I honestly didn't like them a lot. I think that on the long term, if you want to do this professionally, you need to look at the fundamental side, because trust me, nobody in a bank is looking at smart money concepts, fair value gaps, or head and shoulders, trend lines, or stuff like this. You need to look at fundamentals. Okay, boys, last question. Again, you can find everything else about fundamentals here. Let me find another question. Too much. Why gold going down in a worse situation currently? I already explained this before. Do you judge your trading success? This is the last one, guys, then we're closing. Do you judge your trading success based on individual trade outcomes or on how well you executed your process over a series of trades? This is smart. This is a smart question. Both, okay? You need to look at your process, but not about, okay, I respected my rules, okay? You need to look at your process in the realm of wanting to optimize it, all right? Because you see, the weakest point of technical trading, for me, technical, I don't want to piss you off, but for me, technical is also smart money. Okay, technical for me is everything that only looks at chart patterns, etc., etc. For me, this is technicals. Okay, I think that every only chart-based approach on the long run as what we define as alpha decay. You don't have specific information. You're not inputting anything in the market. If you want to know specifically this part about why I think that stochastic approaches are not good, there is this video. It is a masterclass I held in Rhodes in Greece where I explain this. It's live, so you can go and look at this. But I don't think that on the long term we can really see profitability with technicals only. You should see your approach. You should optimize your process based on a lot of variables. Okay, specifically, the thing about fundamental only approaches, technical only approaches, is that if you, as you were saying, you execute your plan perfectly, if you execute your process perfectly and you get a stop loss, okay, why did you get the stop loss? You need to understand the reason. So if your process is about, I'm just saying it randomly, I wait for the Asian liquidity sweep, then I wait for an inverse fair value gap, and I open with targeting the Asian session highs, okay? I'm just saying random. If you expect the process perfectly, so you don't make mistakes in the meantime, and you still get a loss, what is the reason? Your average trading mentor, trading course seller, what will tell you? No, because losses are part of trading. Yes, this is true, but the market don't move randomly. So even if you go and log your process, etc., but you just say, okay, I expected the plan perfectly, potentially you can't optimize. The beauty about fundamentals is that even when I take a loss, I still take losses, of course. I can always resort to a reason, because ultimately markets will always move because of fundamentals. So even a loss, it is an additional data point that I can implement in my trading approach that will make it better over time. So it is a smart question. You shouldn't judge you on individual trades. At the same time, you need to have winning trades, because mentally, for me, in my specific example, I saw a very big turning point in my profits, in my results, when I started to focus more on the win rate than on the risk to reward ratio. Because even if you have an average win rate, an average risk to reward of 1 to 10, okay, an incredible, doesn't exist in the real world on the long run. I made a video about this as well, okay? If you want to see about risk to reward and win rate, there is this specific video that talks about it, okay? So in general, even if you have a very good risk to reward ratio, but your win rate is low, you can possibly be profitable. All the bullshit that they say, yeah, a trader needs to be stone cold, it's bullshit, guys. We are humans, okay? We practically are humans. We are not machines. We are not necessarily made immediately for trading. We need to use our trading and adapt it to our own persona, to our own characteristics. If you have a win rate of 1 to 10, a risk to reward ratio of 1 to 10 and a win rate of 20%, okay? If you look at a Monte Carlo situation, mathematically you would be profitable. But because we are human, you can't realistically remain calm and cold when you get one take profit every 4 losses, okay? This is not feasible. So again, yes, you should always look both at your win rate, because having good results, having profitable trade will reinforce the patterns in your brain that brought you to have this kind of analysis, okay? But at the same time, you need to optimize your process with intent, not just, okay, I have these rules, I need to follow them. It's not hard to follow rules at the end of the day, okay? It's one of the initial trading mistakes that a trader can do, FOMO, over trading, revenge trading and stuff like this. But at the end of the day, following rules is not hard. A machine can do it. You can do it as well. You're smarter than a machine. You should optimize your process in the sense, okay, I need to understand why I do this, why I don't do that, yada, yada, yada. So this is the biggest thing about it. Right, guys, this was the last question. I see you posted a lot, but no worry. If I take a 1-to-1 risk to reward ratio on every trade, is it good or not? Depends on your win rate in that case. You need to look at your expected value. The expected value, EV, is another metrics. The expected value, basically, it is the relationship between how much you expect to do on your average win streak and how much you expect to lose on your average lose streak. I talked about this as well on YouTube. If you want to see why, if one-on-one is okay, there is this specific video that talks about it, and specifically on prop firms, okay? Okay, guys, no worries. We will have 100% other sessions together, so this won't be the last one. Important, Fundedelite is writing now in the comments to join the giveaway, join the Discord and react with an emoji to their latest announcement post to be eligible for the giveaway. Okay, so guys, for the giveaway, 3 challenges worth 100k, 1 step light. Go on the Discord of Fundedelite and react with an emoji to their latest post to join. I hope that you like this first session. Again, we will have possibly others in the future. I wish you very good trading. Always trade with your head. Don't try to copy stuff. Always try to reason. Always trade with intent and with logic. And I'll see you in the next one.